Good morning, everyone, and thanks for joining us for today's webinar with Rex Collins. My name is Michael Ellis, and I'm the publisher of Rural Lifestyle Dealer. Today, Rex is going to be analyzing some of the data gathered in the United Equipment Dealer Association's Cost of Doing Business study, and he's going to offer some insights regarding the financial ratios dealers should be measuring and the benchmarks you're going to want to strive to achieve. Rex is what you might call a dual threat in the sports world. He's a CPA, but he's spent a good amount of time in the retail equipment world in a former life, so he's going to be pretty well positioned to help us all make some sense of the numbers. Now, before I turn everything over to Rex, we just have a couple of housekeeping items. On your screen, you're going to notice a white arrow in an orange box, and you can click on that arrow and choose question to open up the question field. That's going to allow you to submit your question at any time during the presentation. Now, time permitting, at the end of the presentation, we're going to look to have Rex answer as many as we possibly can. Now, if we don't get to all of them, we're going to send those remaining ones home with Rex so he can answer them, and then we'll post those answers up on the website along with the archived replay of the webinar so you can go back and review it when you like. Now, if for any reason during the presentation your connection or our connection should happen to fail and it looks like the webinar has been interrupted, just go back to the email that you received earlier telling you how to join the webinar and you can re-enter that way. Now with that, we should be ready to roll, so I'm going to turn the controls over to Rex. Good morning.
Good morning, Michael. Thank you. And for those of you that haven't met me, yeah, Michael probably said it right, dual threat. I say it a little differently. I'm probably the strangest CPA you're ever going to meet. Probably the only CPA that you'll meet who's run a service department, GM'd a dealership, and actually owned a dealership as well. Our practice, as you see on my slide there, I head up the dealership industry group for HBK and have worked exclusively with dealers since 1987. I don't have any clients who are not dealers. We do take a very much a hands-on approach to working with our dealers, and we've got the operations experience to help our dealers increase profitability, either through increasing gross, decreasing expenses, or reducing taxes. And it's important for you guys to know part of the reason that we're doing this benchmarking discussion is it's not about what you make, it's about what you keep that counts. So moving on, there are a number of slides. If those of you that have downloaded the handouts, you're going to see there's probably 70 slides, and I'm talking for an hour. And we're not going to go through all the slides, just so you know. But there's a lot of materials on there that I have found dealers like and have found to be beneficial, covering those topics. And a lot of it is just things that you can look at home. But as Michael said, give me a call. My contact information's at the beginning, actually right there. And it's also on the last slide. So if you think of a question after the meeting, feel free to send me an email or give me a call. First thing that we need to talk about is why are we measuring things? Well, I suggest that you need to measure everything that you do. And Albert Einstein said that defined insanity is doing the same thing over and over again and expecting different results. Another British, this time British scientist, Lord Kelvin, stated that you cannot improve what you cannot or do not measure. I like what Thomas Monson, this quote has a dual attributes. It's sometimes referred to as the Pearson principle. So either Monson or Pearson put this out there, but it's important. And the last half of this quote is important. When we deal in generalities, we will seldom succeed. When we deal in specifics, we will seldom fail. Now, here's the important part. When performance is measured, performance improves. When performance is measured and reported, the rate of improvement accelerates. So why is benchmarking vital to your dealerships. And you see on there are some sources for you of places to get different things. AED's cost of doing business study is one of those. 20 groups, manufacturers data. But why is benchmarking so vital to the success of your dealership? Benchmarking provides us the ability to compare our own company's financial performance against other dealers as a whole, or companies of comparable sales volume, or companies within a similar line of business, maybe even other dealers operating in a particular region. And furthermore, I like to talk about high performers. Benchmarks, sometimes the benchmarks you receive are average. Well, raise your hand if you aspire to be average. If you coach your kids' little league teams and you say, hey guys, we want to be average, okay? Now there are circumstances where we've got a failing department or an underperforming department where getting to average would be great. But what we strive for is over time to become a high performer, what I'll call best in class. I'll use the terms interchangeably, high performer or best in class. So this benchmarking allows us, if we do this right, to improve our performance so that we become a high performer. And when we talk about, when we as HBK put our metrics together, we are trying to get, we've got two sets of metrics, one for average and one for our best in class. Spotting significant differences between your own dealership's performance and this comparable can be the first step in improving your own performance and making you and your team better. A deviation between your company's figures for any of the metrics and the numbers that you come up with is not necessarily good or bad. It merely indicates that you've got to dig a little deeper. Additional analysis is going to be required. As a general rule, though, the larger the difference between your performance and the metric, the greater the need for further investigation. There are situations where large deviations are found to exist. And in those situations, for your dealership, it may be helpful to go back and review or calculate the same performance over the past several years to get a trend, to identify any trend that may exist. Additionally, benchmarks should be used as a tool for informed decision-making rather than absolute standards. Companies differ as to their sales emphasis, their customer relationships, their location, their size, the industry they serve, the local economy, and any two companies can be successful yet have different experience with regard to certain performance measures. While it's important to analyze financial information in dollars and cents, it's essential that percentage and ratios be used if the data are to be compared to past performance or to reported standards or to the metrics that I'm going to provide today. For example, while it's helpful to recognize your annual employee compensation expense, it's even more essential to compare this expenditure with the value that it's producing. In essence, for the dollar spent, how much gross profit am I getting? Okay? Or how much gross profit on a per employee basis is being generated. These are more useful because it puts into relation the benefit, which are the sales dollars or the gross profit dollars. I tend to use gross profit dollars versus the expenditure for payroll. Additionally, just as dollar figures are not overly meaningful by themselves, ratios can't be used in isolation. In combination with the flat dollar amounts, ratios can provide an extremely accurate overall picture of your dealership's financial performance and your financial position. Even relatively simple analyses of your organization's own figures using benchmarking data or metrics can yield important insights into your business. You don't need to be a financial expert to benefit from this information. For illustration purposes, I've got some key benchmarks listed here on this slide. There are actually two benchmarks that, one of which isn't even on this slide, that I look at in any time I'm looking at a store. Whether I'm looking at that store for transaction purposes, somebody's wanting to buy it, somebody's wanting to sell their store, whether I'm looking at it from a profit improvement standpoint. The first analysis that I do is gross profit per employee. And typically, I'm going to try to dive as deep as I can to come up with what that gross profit per employee is on a departmental basis or on a team basis if possible. The more refined I can get this, the more meaningful it is for me. The other thing that I want to mention here are there other metrics that I look at: return on assets, return on equity, return on sales. The other metric that I look at universally, I will look at every time, nearly every time I'm looking at a store, is fixed coverage or fixed absorption. We've got a whole section a little later that we're going to talk about fixed absorption. That's how important I think it is. So as we talk about gross profit per employee, again, this is one of the first things that I look at. And one of the things that I have to warn you of is make sure that you've got good data. Gross profit is typically good data, okay? That's a number that is scrutinized by the accounting staff, by the sales staff. That's typically a good number. The problem number is our number of employees. Sometimes I've got a number from a few years ago that's no longer accurate. Well, that's going to skew my analysis. Or I've counted everybody. Well, what I need to just be counting are full-time equivalents. So if I've got 2 part-time people, that's 1 full-time equivalent. So it would change my number in this. And the math is pretty simple. I've got the math on each one of the slides as we go through here. I'm not going to talk about the math. Everyone in attendance can do that math and they see how it's calculated right there. But I do want to talk about some other things. Excluding technicians, the gross profit per employee that we see on average for equipment dealers is about $200. Well, for last year it was $207,000 per employee. Our high performance stores, our high performers, are $243,000 gross profit. Why do I look at this gross profit per employee? As I said, it gives me an emphasis on talent. When I have a discussion, I can talk about the performance of our people, and it can be a pathway to discuss improving our own talent pool. Maybe eliminating our C-level employees and upgrading to A and B level only. I will track this on a monthly basis. So in the example that you've got in front of you, that's $141,863. I'm going to look at this every month, and I'm going to say, you know what? I need $11,822 per employee per month is our metric. And so we track this. The other reason I look at gross profit per employee on every store is that there are really no adjustments that need to be taken into account for a accounting convention specific to that dealership. Gross profit is generally calculated the same way by everyone, and so I don't need to make any of those types of changes. Gross profit per employee is a conservative output-based measure. And the last point I want to make on gross profit per employee is a question that I get. Why are you looking at gross profit per employee versus revenue per employee? I tend to focus on gross profit per employee because I have seen too many times where pay plans have dictated a high revenue level but low gross profit level. I've been involved in more than one parts department where a parts manager is being paid on revenue versus gross profit. Sales departments can work the same way, where they're selling at no gross profit. They're making sales at no gross profit because that gets them a higher compensation. Even if the store's not making any money, they're padding their own paycheck. So they end up working the pay plans instead of working the department, if you will. I'm going to go quickly through the other metrics that we've got here. Return on assets, again, I'm not going to do the math. Are the average equipment dealers doing about 5%, 4.8% last year. Our high performers, though, are at 12.6%. That's a pretty big difference. What this ROA does is it indicates how profitable a dealership is relative to its total assets and gives us an idea of how efficient management is at using assets to generate net income. Return on equity, there's a quote here from Peter Drucker on creating wealth, basically equity. Why do I look at return on equity? This is a measure of the profitability in relation to the investment that the shareholders have made. In essence, how well is management using the capital that's been invested, not all the assets, but all the capital that's been invested by the owners to generate net income. The average equipment dealers running at about 16%, and our high performers are running at almost 27%. Again, a big difference there. Return on sales, I'm typically looking at net income before tax, okay, just so you know. And we're looking at net profit margin. Our high performers are at about 8.2%. I've got a dealer or two doing north of 10% return on sales, so net income percentage. Those are really solid performers. Typically, to get to that type of return, you've got to have a pretty strong fixed operations department. And we'll talk about that here in a little bit as well. And this is simply the net income as a percentage of each dollar of sales. All right. Debt to equity. The bankers like to look at this. Okay. This is just simply the total liabilities divided by the total equity. In the example, that's 1.9 to 1. Our high performers are leveraged at about 1 to 1. So they're doing real well, and the bankers love that. This is a measure of the dealership's leverage, or how much debt is the dealership using to finance its assets relative to the invested capital by the shareholders. The question I get here frequently is, so do I want a high or a low debt to equity ratio? It's not really a straightforward answer on that. A high debt to equity ratio indicates the company may not be able to generate enough cash to pay its bills. Okay, if I'm leveraged too high, that could be the concern. However, too low a debt to equity ratio, which the banks love, indicates that the company may not be taking advantage of a higher opportunity for profits that financial leverage or borrowing money may bring. We've all heard the old adage that I like to make money using other people's money. I like to borrow money and get a high return off of it. So just take a look at debt to equity. Your banker is. Asset turnover. This simply measures the efficiency of a company regarding the use of its assets in generating sales. I will generally look at this by category. I'm going to look at inventory turnover. And then furthermore, I'm going to look at my new inventory turnover, used inventory turnover, my parts turnover. And even within that, when I look at my new inventory turnover, I may look at specific lines within my new inventory, high horsepower, low horsepower, et cetera, et cetera. And our high performers here are getting a 1.7 total asset turnover, not inventory turns. Hopefully they're doing better than that, but 1.7 on total assets. Net working capital is a metric that the banks will also look at. Your manufacturer is looking at your working capital. And that formula is on here. It's our total assets plus the general working capital formula is total assets minus total liability. However, in dealerships, frequently the manufacturers have an adjustment to that. They will have working capital as your total assets minus your total liabilities, also minus your long-term debt. Not every manufacturer does that, but some do. We also have further adjustments where our total assets are less our total liabilities and long-term debt. We get to add back debt from the shareholders. The manufacturer is going, that's just like capital in essence. We can subordinate that. And then if you're on LIFO, which most of our dealers are on LIFO, we add back 60% of LIFO, the 40% representing what would be taxes that are owed on that. And so that's your working capital formula. What that does is it measures the short-term liquidity of the business. In essence, it's the ability of management to utilize assets in an efficient manner. Now, we've moved fairly quickly through that section. I'm going to spend a little bit more time talking about fixed absorption just because it's so important and it touches on so many things. And a high fixed absorption rate will recession-proof your store. So what are we looking at in an equipment store? First of all, what is fixed absorption or fixed coverage? Those are interchangeable terms. What it is it's the ability of the parts, service, and rental operations to cover our overhead expenses for the entire dealership. Okay? To put this into perspective, the average dealer is hitting at about a 68%. The high performers are at 82%, and our excellent performers are realizing in excess of 100%, 115% actually, fixed coverage. In essence, what that means is those super high performers don't have to sell any equipment and they're profitable for the month. Okay. Calculating fixed absorption is one of the most important business strength measurements that a serious dealership owner and manager can make. Again, in case you're not savvy on this, fixed absorption or fixed coverage is a calculation of the gross profit generated by the fixed departments, that's service, parts, and rental, divided by the total, and that I do mean total, of the dealership's overhead expenses. For example, an operation might have a 50% fixed absorption rate, leaving 50% of the expenses to be paid by the variable departments, new and used sales departments. Service, parts, and rental are referred to as fixed, not because they fix things, parts and service, but because they're supposed to be somewhat consistent and fixed. In essence, machines break, we're going to get that work. And they're somewhat fixed regardless of the current economic condition. On the other hand, the variable departments, sales departments, are referred to as variable just simply because they're highly affected by market conditions, highs and lows, which no one can control. So if you have a low fixed absorption, the question then comes, since it's the gross profit out of your fixed departments versus the expenses for the dealership, the question I have, if that ratio is too low, is are my fixed departments returning a lower than expected gross profit percentage, or are my expenses too high? And then we still have to dig deeper. If my gross profit is too low, is it my parts department? Is it my service department? Is it my rental? Conversely, if my expenses are too high, which expenses are too high? So this is an exercise that is very, very meaningful for the dealers. And as you're laying out your strategic plan or your business plans, I would tell you that the dealer that focuses on absorption dollars is going to be miles ahead. And if we can get to 115% fixed coverage, you'll have a top performing store in many, many areas, in the variable areas as well, most likely. So again, there's the formula. I've already talked about it. Okay. So what drains, let's say we've got a problem in our absorption and we decide, you know what, it's in our service department. So I want to walk through digging deeper. Okay. Most of the time, a service department's profit is affected by process failures. And these process failures are poorly designed or not followed processes. And these can include waste or redundancies. Bottlenecks are a big problem, okay, in the shop. And those can relate to just the flat organization of the shop, the layout of the shop, the lot organization. I was working with a dealer who they had such restricted shop space that they had to pull all the equipment in at night and out in the morning. Now, this took them about 45 minutes every evening and every morning to bring the equipment in and to pull the equipment out. Talk about efficiencies and problems. So we basically added on some storage space, staged the equipment, and increased efficiency. We were finding an hour and a half every day. Well, an hour and a half a day at your rates is meaningful dollars. Another bottleneck is obtaining parts and having the parts available. And one of the big problems is information flow. The idea is these 4 items are presented in the order of ease to implement, at least in my opinion. Reducing waste and turning more work. Reduce your customer downtime. That not only helps your profitability, but it is a value add to the customer. The less downtime they have, the lower their operating costs, the more revenue they're generating, and it's going to improve your referrals and the willingness for your customer to bring their equipment to you. Eliminating waste also enables the technicians to spend more time in the bay generating service revenue rather than walking around finding tools that they need or finding parts, obtaining the parts that they need. And because of the referrals, it increases our customer base, referrals and repeat customers, and it increases our customer base. So what's driving our repair order cycle time processes? Maybe technology problems, maybe measurement problems. So you've got to look and dig deeper. It oftentimes comes down to not just the dollars. So the accountants can only do so much. Your office managers, your clerks. You've got to dig into the processes to fix things. Okay. The lifeblood of a dealership is cash. And those of you that have spent any time in a dealership can attest to the fact that the cash position in a dealership in the matter of a few hours can turn hundreds, if not millions of dollars. If you have a sale that goes through, I've had to whiteboard this too many times for bankers who don't understand. Okay, so tell me again, you sold this equipment and you made a lot of gross profit. You're making a lot of profit, but you've walked backwards from a cash flow perspective. Run that by me again. And so I whiteboard for them. I show an example where we sell a piece of equipment and we make profit on it, but oh, wait a minute. We had a trade-in. And until we sell that trade-in, it's not converted to cash. So we could have walked backwards cash-wise because we've got to pay off the floor plan on the unit that we're selling, but we haven't realized all the cash, or we haven't received the contract, or whatever it is. So this is important that you as a dealer operator understand this, that your office absolutely understands this, and this is something that needs to be monitored and reviewed on a daily basis. So cash management is key to long-term viability. As I said, dealers tend to experience very volatile cash balances, and sometimes manufacturers' policies drive cash considerations. Some of the manufacturers have requirements, like they have working capital requirements. They've got cash requirements as well. The dealer, as I said, the dealership cash position needs to be reviewed with top management on a daily basis. I suggest that it become part of your business operations doc or your daily operating control. Basically, we have some dealers moving away from docs and it's a dashboard item. Whatever it is, it needs to be communicated, and you need to make sure that the dealer knows where he stands. There are some key accounts. This is just my opinion as to, we're not going to spend a lot of time on these, but as to what I think are the top 10 most important items that can impact our cash position. The cash account themselves, if we've got idle cash setting, for example, we should be investing that, okay? The next slide, again, you have copies of these, or you have the ability to get copies of these. I'm not going to talk through each of these in detail. These are really meant for you to refer to and work on your own and to use as a resource. Parts inventory, you've got that. Deal receivables, moving forward. Okay, contracts are important, and there are some specific suggestions that you look at on the accounts receivable as well, and all of these items. All right, warranty can eat up, as you know, can eat up a lot of your cash sitting out there in uncollectible claims. Okay. All right. Days supply of cash. This is a formula. I've got slides in here for you to look at on how that's calculated. Again, I'm not going to spend any time on this, but what I do want to spend time on is cash management. And again, these are just formulas you guys can work through on your own. But what I want to talk about is cash management and what it takes to actually operate the store and how to properly manage cash. You see on the slide in front of you, these slides, we're talking about break-even point. That is something that most of my successful dealers know how many units they need to sell in a month, new, how many used, in order to break even. And so that's an important item. Cash management, or the search for hidden cash, unlocking, unfreezing your cash or your capital. This is important. I go into too many stores, and you'll see in this example, the example that I've got is an actual dealership that I went into where they had excess capital just locked up in their balance sheet ineffectively managing their assets and actually hurting their performance in a major way. Okay, so let's talk about parts. Have your own. It's going to vary from industry to industry and dealer to dealer, but taking a look at your aging, I would suggest if you've got parts that are over 90 days and it makes up more than 25% of your inventory, you've got a problem. There's a fact that we know, and that's that I want to look at my less than 10% of parts with no sales activity in the last year, because here's what we know. An active part that hasn't had any sales activity in the last 12 months, you have less than a 1 in 10 chance of ever selling that part. Ever selling that part. So you've got an asset on your business that you paid full dollar for that you're never going to realize dollars for, or less than a 1 in 10 chance that you will. Okay? So we need to monitor that. You will have obsolescence. You have parts that go into that category, but make sure that it's less than 10%. My high performers are running around 5% on that. So make sure your parts manager is managing that asset. Used inventory, again, this is going to vary, but used units that are over 60 days old that haven't been sold, I get a little concerned about, not overly concerned about. When I've got units that are having birthdays, I've got major problems. This inventory that you guys have out there, it rots. It is not a fine wine. It gets better with age, okay? This rots and deteriorates, rots and rusts. I am looking to having, as far as used inventory, if I'm managing this thing lean, I want to have no more than 1 quarter or 3 months supply of used inventory on the ground. Deal receivables. If I'm waiting to collect money from a customer who bought my whole goods, it better not get 30 days old. Okay, we'll talk about contracts. Contracts, if I've got a contract that hasn't been cashed, bank financing that we all put together, and it's over 5 days old, what the heck's going on? Okay. My trade receivables, my parts and service receivables, my rental receivables. Really, these should be less than 25% of what my month's business has been in those departments. Aging balances are always a problem, and getting on them sooner than later is your resolution. New inventory, 60 days supply on the ground. This gets back to managing my used inventory. If I manage my used inventory and I'm replacing a piece of equipment with a new piece of equipment, if I'm managing my used, I'm selling that in the same market. I'm maximizing my dollars there. So even if I have to take it to a jockey or take it to an auction to get rid of it, I'm selling in the same market in which I took it in on trade. Hopefully I'm not going to incur too big a loss, if any loss at all. Warranty receivables, very few manufacturers, some are paying on a weekly basis, which helps us from a cash flow. If that's the case, then you really shouldn't have anything older than 7 days. If we're back at the traditional, I really don't want anything more than 30 days old. Some of these things are pretty self-explanatory to you. My cash count, I mentioned this earlier. Let's play the float. Let's look at our sweep accounts, and let's do manual sweeps if we can. Let's sweep against our floor plan, so that, you know, if you just leave the money in your bank account, you're going to get nothing for it. If you do a sweep through the bank, by the time you pay the fees, you're getting small return on that. It's better than zero. Not saying don't do it, but if we can take and set up an arrangement where we can take excess dollars and invest that for a day, a week, a few days, whatever. Basically, take that money, pay down our flooring obligation. It's the same as receiving floor plan rate in return. That's a whole lot better return than what the bank will pay you. So work with your lender and see if we can get we've been very successful in getting that established. Okay. Finance reserves, for those of you that are actually placing the financing, less than 30% more than last month's production. And the reason that it's more than 1 month is sometimes the cutoff's different and you got to push at the end of the month because we've trained our customers. You want to get the best deal on this piece of equipment. Come in at the end of the month when I'm trying to make my paycheck for the month as a salesperson. So you end up with some of that push at the end of the month. And then any other receivables. Let's let the bank be a bank. Any employee loans, need to encourage them to go to the bank and get a loan. I don't need to be doing that. And then fleet rebates, fleet incentives, whatever it is, make sure we get paid our money by the bank. Not the bank, by the manufacturer. I'm sorry. Now, this is the actual analysis that we did for a client of ours. Okay? And we went through their new inventory. And I'm going to walk through this first slide. They're all kind of set up the same as we go forward in the slides. But I'll go through this one in detail. So this dealer, at the end of this month, the month of September, as a matter of fact, is what it was, had $4.9 million, $4,945,464 in new inventory on the ground. This same dealer, their year-to-date cost of sales was $12,317,000 and some change. This was not the current year, but it happened to be September, okay, of that year that we were looking at. So we divided that total year-to-date cost of sales by 9 to get what our average monthly cost of sales is of $1,368,000. This dealer had was trying to manage aggressively their inventory. They wanted no more than 1.5 months supply. Your situation may be different. You may decide, you know what, we want a 3-month supply of inventory on the ground. Okay? We need to come together as a team and come up with what that metric should be given your specific circumstances, your specific customers, your specific business model, so forth. So then I take the $1,368,000, multiply it times 1.5, which is a month and a half supply. That says I should have on the ground $2,052,876. I have an excess amount. I have an excess amount of $2,892,000. If our floor plan rate is 9%, which that's their floor plan rate after all the interest-free days and so forth, is what that was. This is a little dated as far as the rate, but the concept's still the same. So 9% of $2.8 million is $260,000. We are 3/4 of the way through the year, 9/12 of the way through the year. That results in $195,000 of cash drain. I've spent too much on interest, if given what our own internal benchmark needs to be. And again, that guide, I've said this, I'm repeating it, needs to be unique for your dealership or your industry. Generally speaking, higher gross profit items have a slower turnover, therefore a higher days supply than lower gross profit items. So it does depend on what you're selling. We move forward and used inventory. This set up the same way. We've got at the end of September, we had $2,189,000 in used inventory. Year to date, $13.6 million in cost of sales. Divide that by the nine months, because we're in September, gives us 1.5. This dealer wanted a very heavy turn, quick turn on their used at a 1-month supply. Okay? That yields $671,000 beyond what this dealer wants, setting in cash or setting in inventory instead of setting in his bank. Okay? Moving forward, parts set up the same way. $298,000 in inventory Our average month is $119,000. 2 months supply is what this dealer wants, which is $238,000. We've got excess of almost $60,000 sitting in that inventory account that's not making me any money if we're operating it, or the right return if we're operating properly. This slide's a little different. I'm looking at our parts, service, and rental receivables. I'm looking at them 2 ways. The first way is just totally, what are my receivables? I've got $120,695 in parts, service, and rental receivables at the end of the month. This dealer wasn't heavy in the rental. My year-to-date sales in those departments, $3,554,000. Divide that by 9 months is $394,000 average times 1/2 of 1 month. We want no more than a 15-day supply. That gives us $197,000. But look, as our guide, but look, we've got less than that as an actual. Hey, we beat our own guide. My guys are doing a good job of collecting our receivables. We're ahead of the game by $76,000. But I'm not done there. I also want to look at the past due amounts. Those can be killer. And I don't want any more than 10% of my balance in receivables being past due. So in this case, I've got $15,025 that are past due. My receivables are the same $120,000. 10% of that's $12,070. I have more than what is acceptable for me by $2,956 of aged receivables. Okay. Warranty, set up the same way. I've got $28,000 in warranty claims outstanding. Do the math. I should be at $13,000. I got $14,000 too much tied up. Contracts, same math as you go through there. I've got $634,000 tied up. Now, if I look at my finance receivables, I've got $67,000 in finance reserves related to the sale of equipment. My current production is $130,000. I made $130,000 in placing loans for my customers last month, and I am fine. My management goal is to be at 1.3, as I talked about earlier. The reason why. That's 170. Look, I'm to the good by $102,000. That's a good thing. Okay. Going forward to what does this mean? If I add up those last slides, okay, the new inventory, the used inventory of $671,000, the parts inventory of $59,000. Do not add in the negative $76,000 that we had on the parts and service receivables. Okay, but subtract it, add it as a negative. I end up with $1,399,000 of excess cash invested in the business that the dealer, based upon their operation desires, is not realizing a return on investment for. That's cash he's got in there that he's not making an adequate return on, in his estimation. Now, I would tell you furthermore that if I add back the ones we're doing a good job on, and get the other items back to being at metric, I've actually got $1,578,000 in opportunities to bring that in. That's a large number, and we need to eat that elephant one bite at a time. And we use our metrics, we manage to it, and we start improving our performance as soon as possible, with the end goal of meeting the metrics. And again, I want to emphasize, the metrics for that actual dealership are not going to be the same metrics for you, for your store. They might be, but not necessarily. Okay. I've left about 10 minutes for questions and answers. And guess what? It's 11:50. I did well.
It's perfect timing.
Laura, Michael, are there any questions?
Yeah, we do have a couple to come in here for you to address. And I know you touched on this earlier, but we did have a question come in about the ROA. Could you go back and revisit what a healthy ROA is for a retail outlet?
Sure, I certainly can. The return on assets, and I'll review the whole thing. The return on assets are calculated, because I didn't talk about this, but they're calculated pretty simply. It's your net income, pre-tax net income, divided by your total assets. And the typical dealer average is about 4.8%. That's equipment dealers. And again, that's all equipment dealers. Our high performers, our best in class, are returning 12.6%, and that's 2016 numbers. That's not year-to-date 17. We've not updated for that, and won't till the end of the year, till we've cleaned everything up. Now, although not part of the question, you were asking what the metrics were. Again, what is this telling us? What are we trying to measure on a return on assets? What I'm trying to measure is how good a job my managers are doing in turning my assets into profits, in essence. So how profitable a dealership is relative to the total assets that are generating that profit. Does that answer, you think that answers that question, Michael?
I do. I think that hits it pretty well. Here's another one. What should total expenses, not including tax, be as a percentage of total sales?
Yeah. And that's not including taxes, which is good. Our benchmark for our dealers that we want best in class, throwing all equipment dealers in the same mix, and it's going to vary a lot depending on what you're selling. If what type of equipment you're selling. And as an aside, I'll tell you, if you are a specialty equipment provider, this number is going to be higher than if you are a general construction equipment provider, or if you're a dealer in ag equipment, depending on the specialization you have. The more specialized you are, the higher return you generally get, bottom line. The equipment dealers are returning 3.6%, okay, so the on sales. So you're running 96% of total revenue are your expenses. That includes cost of sales. That's all of your expenses coming down there for that. That's the average. Our high performers, and what we try to get our clients to, is 8% or more. And I think I mentioned that we've got dealers that are absolutely in double digits on their net income percentage. And so if net income is 10%, that means you're spending 90% of your sales dollars generating those profits, covering that. You have any another question, Michael?
Yeah, I do. And this goes back to the earlier discussion about the gross profit per employee. This is kind of a two-pronged question. One,
Gotcha.
can you explain the full-time equivalent again and the reasoning behind that?
Yes.
And do you figure the part-timers, does it vary how you figure them into your total depending upon how many number of hours? I mean, if you've got a
It
30-hour
does.
employee versus a 10 to 15-hour employee? Do you weight them the
It
same?
does. It does. And we do weight them differently. And basically what I'm doing is, if I've got I'm going to take all my part-time people, and so I've got 6. I'm making these numbers up on the fly, so my math may not work, although I do have a calculator sitting right here. And let's say I've got 6 guys working 30 hours. Okay, so 6 times 30 is going to be 180 hours, and I've got 2 other guys working 20 hours apiece. Okay, so that's going to give me 220 hours. Okay, and those are all my part-time people. I'm going to divide that by 40, and that gives me 5.5 full-time equivalents. Okay, so if I've got 96 full-time people and 5.5 part-time people making up, I've got that X number of part-time people that equate to 5.5. I've got 101, 96 plus 5.5, 101.5 people. And that's the math that I would use. So I think going through that little example answers actually both parts of the question. The full-time equivalent is just trying to come back and say, okay, I'm working, because quite honestly, the workforce has changed. We have a lot of more flexibility. We're having to offer a lot more flexibility to grab workers. So we've got people who are job sharing. We've got workforce development issues. I was down in New Orleans for equipment dealer workforce development meeting, basically 2-day meeting. And it's terrible. Try to find a mechanic. Any of you will complain about trying to find a mechanic. You can't find them, technicians. So it's very important. So we've got to be flexible, and we are being more flexible with our hiring practices. Not our hiring practices. You still need to be diligent about who you hire, that they can do the job, because this is interesting. And I don't have the numbers in front of me, but this is a metric that's out there. For every employee that you hire who is a bad hire, it costs you 20%. Okay? So if you hire a guy for $100,000 and he's the wrong guy, it's costing you 20 grand. Here's the telling tale. For every employee that you hire and keep on who's disengaged, who's not engaged in your process, not drinking from your Kool-Aid, if you will, it costs you 34% of his salary in the form of, so that'd be 34 grand that guy's costing you. And it affects you in so many ways. His gross isn't as strong as it should be. His customer relationships aren't as strong as they should be. His repeat and referrals aren't as strong as they should be. All of these things are negative, okay, for you. That isn't the question, but I went tangentially and just showing you how these metrics show up everywhere. So let's get the right people on the bus and get them moving in the right direction. Sorry to have gone down a tangent there, but it's pretty important. People are very important to us right now, and finding them is very difficult. Finding the right talent.
Yeah, that was a great point, and one I hadn't considered about the changing face of the workforce and how everybody's got to adapt to make sure.
You know what, Michael? I'm gonna interrupt you, and we're seeing, and this is so important, the workforce. I'm working with so many clients. How do I keep my guys engaged? How do I find people? All of these things. We've got a dealer client right now. Most of the dealers, in order to find technicians, they're working with the local vocational school. They're working where they can. They've got a relationship there. Many of the dealers have already, they know about it if they're not doing it, but they know about, hey, let's do some sort of a program, an internship program, where the technician that's going to school during the day maybe works for me on the weekends, or 1 week at school, 1 week off. I actually have a dealer right now who has started paying those students that are sitting in class. He's paying them while they're in class, $10.50 an hour actually, to be in class. And then when they're working for him, he's paying them to work for him as well while they're going through school before they're even able to actually come to work full time. Now, there's a contract, there's an employment agreement, if you will, and then upon hiring, they're getting a set of tools to do their job. That's how far we're going to try to feed our pipeline of mechanics. Go outside as a dealer today and look at the number of mechanics that you have that either don't have hair or, as you see in my picture, have gray hair. Okay? You have got to be very proactive. I know it's totally off topic, but it's such a meaningful topic for the dealers right now. And that's just the recent solution. I mean, this literally, I've got this dealer that's doing this. He started it probably within the last 3-4 months time period. So it's what everybody needs to do to get people. Sorry, it's off topic.
No, absolutely not. That's pretty creative. I'd be curious to learn how things develop for them and how that system shakes out over time.
Absolutely. I've got my eye on it as well. And, you know what? I don't think it can hurt.
No,
you know,
it's worth a shot.
And, you know, it's worth a shot. And as long as you've got the right contract at the end, and I don't want to go too far over our time, but as long as you've got the right contract with that employee that basically states, hey, this was a loan to you, yep, and you owe it back if you don't fulfill your obligation of coming to work for us, and you have to work for us for 2 years or whatever it is. At the end of 2 years, if he isn't staying, he's not going to stay, and he's disengaged and he's costing you problems and all those kind of things. So I'm going to I don't know if we've answered all the questions, but we did go over. I apologize, Michael.
No, that's absolutely fine.
Send me the question.
Got a couple more.
Yeah.
We got a couple more that we can send back with you, but I do want to be cognizant of everybody's time. So we'll wrap it up here. But as I mentioned at the beginning, today's presentation, as well as the audio and a download, are going to be made available on rurallifestyledealer.com, so everybody can circle back or share it with your team. Keep an eye on your email for notification about when that's going to be up on the website. On behalf of Rex and everybody here at Rural Lifestyle Dealer, thanks very much for joining us this morning. When you leave, a short pop-up is going to appear. Just let us know what you think of the live event. And if you have any topics you'd like to see covered in the future, absolutely let us know. Thanks very much. And thanks, Rex.
Hey, thank you.